Hello friends, this is Rajat Dhar. I'm the managing partner at FINOGENT Solutions, and we are the premium wealth management firm managing assets of high net worth individuals in India and abroad. So having said that, we are in a month of May 9th, 2024, and we have seen market falling like anything, and we have seen many stocks correcting by over 20 to 30%. So what does this mean for an Indian investors? So this video will cover 7 to 8 different aspects, and for every one of you there will be a takeaway. What does this mean? So we'll be covering up the market overview, we'll be covering upon how volatility is impacting your investments. Is it an Indian phenomenon or the global phenomenon, or we are alone into this ditch or not? Then we will be working upon how the different indices within India are performing or getting impacted. What are the sectors in India that are being impacted? How the portfolios need to be monitored for that. There have been the corporate results that are coming for the financial year. So what does this mean for Indian investors? And a crucial case being Larsen and Toubro, where the results have been good, but still the price has tanked, and that has got the Sensex and the Nifty down with it. So what actions as an investors you can take, what we are taking at our end, and what are the key takeaways for you as an investor as far as the portfolio strategy goes. So without really wasting much of time, it is an exhaustive, so be till the end of it, so as to gain much information on the needful. So here we start off. So technically we are talking about Nifty volatility, we are talking about the strategies and the key investor takeaways that would be there as explained. So standard disclaimer on the investments that obviously it is for the information purpose, so and so forth. So now first we will be talking about the market overview. We know that there have been primarily three main developments that have happened. The first development is obviously the Indian Nifty had been at the all-time high, and it had not taken a breather for quite a while, and therefore it was a very prudent opportunity for FIIs and DIIs to book the profit and exit. And obviously the fall is not of 20 to 30%, so as you to be fearful about whether it will fall into the bear market cycle or not. So that is absolutely not the case. So therefore, whatever the investments had gone into the markets over the last quarter, the profit made had to be made. So therefore, the FIIs have taken the money out and they are booking the profit. So that is the main one reason for that. And why it is more so, because the second reason being the Fed rate has not been lowered. And if we talk about the Boston Fed head, Miss Susan, and she has already told that for this year 2024 they are now only looking at two possible times for the rate cut. So that means where previously it was from 2 to 4 times they were expecting the rate cut to be done, that has not been done because the inflation target that they had kept was around 2% for the United States of America. However, that inflation target had not been reached and they are very conservative on it. So they are willing to wait and to see if the inflation tapers down. So that was another main reason. And primarily, obviously, if that rate of interest doesn't come down, so it makes US dollar much stronger because the money flows into US dollar because of the strength of currency by its own merit. And not only that, but also the interest rates that are high there. So FIIs will not be bullish in more or less other markets unless and until opportunity cost is not way above what they otherwise would be getting in the US. So that has been one of the main premium factors for that matter. And this obviously will push Indian government not to cut the rates in India, because obviously being done that, the flow of money will not happen. Say, while we are looking at attracting money into the equity markets, we will see a huge outflow of the money from the bond markets. So an Indian government cannot risk that. So therefore, unless the US doesn't get it down, many of the companies which are dependent on raising funds overseas will be at the disadvantage, where the companies which are in the pharma sector or the IT sector will still be better, but IT sector has its own other issues to deal with rather than rate not being cut. So that will not do much benefit to IT per se, but yes, pharma can stand to gain benefit if the rate cut doesn't happen. So this is the one element. Then there comes the electoral volatility. We had seen that the state elections of Rajasthan and MP had been very great surprise and positive surprise, and on the face of it, it was very positive outlook that Indian government would be made by the current incumbent government. Having said that, the voter turnout at this time is not that exuberant as was expecting. So therefore, there might be certain risk or being at the borderline, but therefore that has not only given an you can say a concern for the investors, but also an opportunity for FIs or other institutions to obviously not be into the market or to book the profits from the market and take this as an opportunity to get the returns into the cash or other alternative markets. So these are the three views if I see from the market volatility point. Now, if you want to see why volatility is so much a concern, volatility doesn't mean that the market is high or market is doing fast. Volatility simply means how much standard deviation or how much spike or a trough is there in the market. So if I may tell you, from 23rd of April till now, the VIX volatility index that gauges the Indian market trend has gone up by around 90%. More than 80%. Now imagine if you are a person, normal heartbeat is 72 heartbeats per 72 or 75 beats per minute, and now it is pumping at around 150 or 200 heartbeats per minute. Do you think you would be able to breathe calmly, or you will be able to climb up the hill calmly? You will not be. So that is what the market is now currently facing. So if you see this what do I say that if you see this graph, we are talking about the volatility index, and volatility index, this 8%. Now I had told about 80%, that is from April 23rd till date, that is of 9th of May 2024. Here I am talking about 7th. This is 7th of May, and we are currently at 9th of May, and this is a 15-minute graph. And what we have done is, we have seen how the volatility has performed. So if you talk of today, say from here, from 9:30 to around 12:30 p.m., volatility was spiking, but then it shots suddenly upwards, and that is the time when the also Nifty went down. So here, if you see this Nifty fall, so if we consider this as a parameter, so here we have seen that the volatility has increased by around 8.89%. That means riskiness, that is risk has increased. That means risk has increased, and the returns Nifty has fallen by around minus 1.93%, which is equivalent to 2%, and this is say from the 7th. So if you want to talk about the 9th, we were here, so still it has been down by about a percent for that matter on an approximate scale. So therefore, we have seen that while the volatility has gone up, the Nifty has gone down. This shows the impact of the risk that is currently there into the markets. Now, this brings us to the second crucial question: is it a local phenomenon or whether it is a global phenomenon? Yeah, what we say, that is the whole world going to dogs? No, it is not the case, because if you see here, what we have done, we have taken Nifty and we have taken the Nasdaq. So this blue is called as the Nasdaq, and this one is the Nifty. And then there is CAC, NYSE, and all other segments taken. But for the illustration, I have taken the Nasdaq. Now, if you see here, this line has been taken as a separator. So if you say it's 29:30, so it is around 2nd of May. So we have taken 2nd of May. So let us see how from 2nd of May to the 9th of May, the markets have performed. So here, if you will see that the Nasdaq has gone up, and it has gone up by around 4.48%. In the same period, the Nifty, sorry, this is not of 9th, this is of 8th, a day prior. So that is last evening's closing. Now here, if we see that, if we talk about the Nifty has gone down by around 2%, or we can say 1.63%. So therefore, while the global markets have been in the upward spiral, we have seen that the Indian markets going down. So therefore, this shows that here Indian markets currently are dilling. They are dilling because obviously it is of the high valuation premium, and therefore the profit booking coming there, and not and on the top of it, there is a volatility in the elections, and corporates are trying to keep cash with them. So therefore, one thing is for sure, it is a local issue. That means India specific. See that if on 9th or you can say the 8th evening, when the Indian markets closed, when the Indian market closed, the Nasdaq had fallen only on account of Fed rate not being changed. Because the Fed rate was not being changed, the Nasdaq had fell. Otherwise, it had been consistently rising for that matter. Now, this brings us to the next crucial point. And now we know that while it is a local issue, we know that it is a local issue, that means concerns India only. So therefore, how different indices has performed within India. Because then obviously, if you have taken stocks, you might have taken stocks into, say, into mid cap, into large caps. You might have stocks, banking stocks with you, like HDFC, Kotak, so on and so forth. So then how these sectors have performed and how the volatility had been there. So if you see this graph, you will come to know that here we have taken Nifty 50, which is the main. Here we have taken the mid cap, 150 stocks of Nifty. Here we have taken the bank, and here we have taken the volatility. If you see here, while the volatility was going down, the markets were going up. So here I'm talking about the mid caps were going up. Here the banking was going up. Here you would see the Nifty 50 was going up. When the volatility started going up, the market started falling. You see the green, the volume, the positive volume started diminishing, and then the sell volume happened. So similarly here, so here you were saying the main Nifty had gone. Now the concern, and same thing happened with the bank. Bank, it happened more. So because we know that there has been a case of Kotak, and then there has been the case of HDFC. We have seen SEBI, RBI after the banking stock. So therefore, there have been much risk. So if you see that during the same period, the bank has gone down by -5%. During the same period, if we talk about the mid cap, they had gone down by 4.17%. While during the same period, there has been a 91%. I'm talking about from here. This is 23rd of April. This is the 97% of the volatility. The volatility has gone up by 91%. So we have seen here mid caps falling by around 4.1, then we have banking at -5, and then we have -3.64% main stocks like Nifty. So therefore, we have seen there how the volatility impacted, and the banking had been the worst hit, and then there had been the mid caps, and obviously Nifty being the large cap is much more stable because it has a good FMCG stocks, healthcare, pharma stocks that would have given cushion to it. So that is now when we look into this, then the next concern comes. Okay, we have seen Nifty 50 and indices, but if we see the whole market as such, and over the past 5 days, if we see if we see the concern over the past 5 days, how the different sectors have been performing. So here, if you see that when we are talking about the metals and mining, there is only 1 and 2. So in all those things, if you want to have a stock portfolio that is much more shock proof or resilient, shock proof can't be there, but resilient for that matter, is the FMCG. Because if you see in FMCG, there is 1, there is 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So you are seeing 11 being in the green. Similarly, if you see here capital goods, so you will see 1, 2, 3, 4, 5, 6, 7, and 8 being in the green. So therefore, if we see FMCG, we have Marico, Imami, Godrej, and all those companies being in the green. You have the Daburs being in the green. In software, there had been only the 2 companies which have been in the green, but otherwise, many of them have been down. Healthcare is one of the factor where you can see Ajanta Pharma, Vijaya, and Alchem Labs being into the green, and a couple of there among the smaller players. So therefore, if you see about the riskiness that has been there, that it has been 100% risk into infrastructure. There have been 100% risk into telecom. There has been 100% into diversified. There have been 100% into insurance, agri, industrial gas, so oil and gas for that matter. And here, if you talk about the bank, except I believe 1, much of it has already been into the red. So therefore, when the markets have obviously the banking and finance have been there, except few outliers. So having said that, if you tomorrow say that, okay, I want to have a better portfolio, I want to reduce the risk of the portfolio, so you now know which segments or the sectors are the one which have the stability. So how much you can diversify your portfolio, how much you can have these stable scripts in your portfolio, so that the whole volatility can be brought down into the portfolio. So now, while this had been at a broader level, but if I just want to give you a glimpse, this was an eagle eye view. So if I want to give you a zoom in view, so here comes into the sector performance, and here we have taken one metals, here we have taken auto, here we have taken infra, and here we have taken FMCG. So like said, FMCG had been only impacted herein where it has been minus 2.91%. And in the same period, the infrastructure had been minus 5% over. And auto has been rather positive. Auto had been positive. It has not been negative, because the very good sales figures have been coming up, because end of the month figures also do come up, and then the results came up. The sector itself was quite a bit. So in case of the metals also, the metals had seen minus 6%. So this is how, and obviously we can go on for sector by sector after that, but this is how you can see. Here you have, during the same period when the banking had fallen by 5% and the other sectors by 3.5%, that mean indices, we have an auto which has been up in a positive line. We have an infra and you can say metals that have been actually hit very hard. So FMCG and auto have been better placed in the current scenario. Now this brings us to the another crucial element for it. That means we know that we are into May 24 and companies are coming with their corporate results. So when we are talking about the corporate results, we have to see 2 points. Okay, which are the best performers, which are the worst performers, but are there any companies which have actually performed good? Are there any turnaround stories which have been a surprise to the market? And if you see that here, if you can see, we have Inox Wind. If we see here March 2024 and December, it has gone, revenue has gone up from 504 to 528, 84 to 69 had been the gross profit, which has been less. The net profit has doubled. So this had been a surprise factor for the markets. Tips Films, one which the names which you can recall for that matter, these are the positive turnaround, and among the in terms of the percentage growth which have been higher, not from the date for that matter. So here you see the 562 1327 from December to March, Tejas Networks, and then net profit has been up by 426 and the gross profit up by 524. So this has been in our selected list for quite a while. It comes under the mid cap segment, and Tejas Network have been a very inclusive stock in many of the aggressive portfolios for that matter. Sterling Wilson has been there into one of our stock picks for quite a while, for quite a quarter now. So if you see that, we have seen here our revenues from 583 to 1178 between December. This has given around 100% better, and Sterling Wilson works into the energy landscape. 100% increase, 219% into the gross profit. So these have been, so if you see PNB Guilds or the MCX India, these are some of the turnaround stories from the corporate results perspective. But while there are these stories there are also some companies which have been the top performers. Those were the turnarounds. That means the companies which were not doing good but now have started doing good. Now here these are the companies which have been the top performer, and this has been as per 952024, because companies are still coming with their results. Many companies are still enrolled, so these will be kept updated over a while. So here if we see the Shakti pumps in March 2024 as compared to March 2023, if you see, there has been the 4,400% increase in the growth of net profit. Again, Bajaj Holdings, we have seen 2,000% of the profit. Jai Balaji Limited around 2,200, Tejas Network 1,400%, Jaiprakash Power 1,400, and then we have the trend up by 1,663. So we have seen that there are scripts here. So you can write to me, or you can mention the scripts that are there in your portfolio for that matter out of them. So now, among all these things, obviously there will be the companies which are not performing. So here are some of the ones which are not performing good. We have seen here Tata Chemicals. Chemicals have been hit very hard, because if I will show you here, you have chemicals. See here, this is the chemicals. It has been very drastically hard. Say if you Gujarat Fluoro, minus 12%. So GFSC minus 11%. You have this here, Aarti Industries, minus 10%. So it has been bleeding like hell quite lately. So we have Tata Chemicals, its results had come out, and this is around minus 735%. Net profit of Rallis India has gone down by 187. However, it has been a very good company, has given a surprise shocker for it. Indiabulls Real Estate, it was expected of it to be in red. Next, if you know that TV broadcast, and you have Inox Green. So Inox Green is also a very surprise that has come up into this year. The profit has fallen by around 133%. So therefore, we need to revisit the annual reports and the portfolios in the light of the recent corporate results and what the analysts have given. So we will have to see the analyst ratings on the same to see what next price point they have kept for this. So now this brings us to the very next element of it. So what I have done, I have shown here over the previous slides that uh, what had happened to the market and what had happened to the Indian markets. Indian markets is completely decoupled with the global as of now, and except the Fed rate issue for that matter. And then how the different sectors had been impacted, how the different indices were impacted, and within sectors we have identified 2 or 3 how the trend has been, what had been the range of impact, where one has been like auto segment being positive and the rest being negative. Among them also you can see the chemicals being in the ditch, and infra and metals being in the ditch. But then all this thing, if you are a very avid stock investor and you have a very big stock portfolio, you need to monitor it. So in need to monitor it, there are certain parameters that you need to look forward to it. So here comes the portfolio parameters that are there that you should look when you are managing portfolio on your own. We, for our clients, do it at our end. But say for example, for any portfolio, you have to see that, okay, I am having the number of stocks. So which are having the risk reward. Risk reward simply means, say for example, if I have invested into a stock, obviously I have invested into a stock for a profit. So therefore I have put a target price and there is a current price at which I had bought, and there has been a variation. So the risk reward tell me and the amount of risk I am taking for the amount of reward. So for example, for every 1 rupee of the risk I take, I will make 3 rupees. This is the favorable risk reward ratio. So when we look at this, and because the markets have been impacted quite gravely and many of the stocks had a straight fall, there would be changes every day as you would see it. So here, if we say among the current portfolio of the stock, because this is the template for it, it shows that the 11 are having the best risk reward ratios, 6 are still having favorable, and 2 are having average. So therefore, if we say that 6 plus 2 is 8 plus 11 is 19. So 19 stocks are favorable and 9 are which will require action. Now their point to it, either you can look each and every stock every time, or you will have a template that will show you, okay, I have a 50 stocks or I have a 10 stocks and these are the 9 stocks where I need to take action on. So this tells you where you need to focus. Then for example, we say that okay, for every trade I am willing to take 1% of the risk. If I am willing to take 1% of the risk and we are taking, say for example, a 50 lakh of the portfolio, I'm looking at around 50,782 on a per trade risk. Okay, any of my stock, if I am willing to exit it per stock, I am willing to make a loss of around 50,000 if I need to exit or make a maximum loss of daily risk limit maximum at the portfolio level. This is at the portfolio level. So unlike current situations when the whole market is falling down, you cannot just keep on buying, selling, buying, selling, buying, selling. So you have to find a midway path where you say, okay, I am making a partial exit, I am protecting the profits that are with me, and for the rest I am trying to view the markets, hold my positions, and then see where I could average them out as the time comes. So therefore, if we see here, there we are looking at the daily risk. Say, suppose we can say that if today I will say the market goes down by around 5%, then should I exit? If it would have been a normal black swan event, then we would have come out of it. But we know that this is the election and Fed rate and couple of other issues coupled. It is not a black swan event. So therefore, we will keep on to it because there has a broad base. However, normally if you are very conservative, then we will look at, okay, theek hai, there have been a 1,52,000 of the loss, I will rather exit. But then the main risk with this is, if tomorrow the market goes up by 2% or 3%, you have missed out that spread. You cannot make it up. So then your story will start after over and above that 2% the jump that happens. So that inherent return that would otherwise would have been there, you would have already missed the bus. So then obviously we can see that what is the maximum drawdown I am looking at, what are the total number of stocks. So I am having a 31 number of stocks. Out of 31, there are 11 which are good, 6 are favorable, 2 are average, and the 9 need section. My portfolio beta is this. This tells about the risk taking measure. This simply means that if Nifty falls by -5%, this portfolio will fall by to 69% of 5%. So that means if the Nifty falls by 10%, if Nifty falls by 10%, the portfolio will fall by 6.9%. So that means we are less risky than the portfolio. So we are, you can say, 69% risky with respect to Nifty. So this is how it is. Now, obviously, we also have to see whether our maximum drawdown is within limits or not. Yes, it is within limit. Is our -3% daily risk limit in control? Yes, it is in control. This is the threshold value. This is the threshold value. So in the threshold value, we are still in control. Now, we have total number of 31 stocks. Are we diversified? Yes, we are well diversified. We don't need to diversify more than that. This is the worst case scenario of the diversification. Being in the, you're getting like phenomenal large number. Optimal should be 12 or 15, but 31 on an average, the client wants around 20 to 25 stocks. So based on the client preference, it could be. So what portfolio beta? So portfolio sensitivity is less than the market benchmark. So therefore it is green. We are also good at this. Then we're looking at the stop loss. This is okay. Concentration risk. Concentration risk means sector exposure. Sector exposure, or no, not sector. I would say that this concentration risk is with regard to script per stock exposure. So that means, say for example, I have got 1 lakh rupees and I have taken say 10 different stocks. Now one stock is having 20,000, one has having 10,000, one is having 5,000. So the concentration risk is 5%. So if it is a 1 lakh, or you can say 10 lakh of the portfolio, then more, not 5% or more allocation should not be. Not one stock should have more than 5% of the allocation. So therefore, again, then you also have what are my stop loss. So how many are the number of stocks? How many are the number of stocks which have got the stop loss at the entry? We entered into the stock and then the markets were negative. So therefore, there have been this stop loss has been triggered in 7 stocks. Then we are looking at 3% beach. Now there would be a stock, say for example, we have got into a stock at 100 rupees and it has gone up to 120 rupees. From there it has fallen to 116 rupees. So at 116 rupees, the 3% stop loss has been hit. So that is 1%. So that means it is a trailing stop loss. I'm talking about the trailing stop loss. So whatever the money we are having, are there any client specific remarks that we need to be careful about? Say for example, the client doesn't want to get into Reliance or any other stock per se, so we can just make a remark, the client is not into this. Or if a client has some stock blacklisted because he's already working that company, doesn't want to be investing into that company because it would amount to insider trading, so therefore we are having this type of remarks that we do put into. Then we had the number of buy recommendations. So that means we are now looking at number of the recommendations buy, and there's a vacancy of -19 because we are normally looking at 12 stocks approximately. It is already well diversified, so that is -19. So therefore we will not be making any changes into the portfolio because it is already well diversified. Had it not been the case, then based on the number of the buy recommendations, we have taken the top 2, top 3, top 10 stocks and then made a change into it. What are the cash balance we are looking at? We are currently sitting on. So therefore, if tomorrow an opportunity comes in, we will just pull in our money into it. And what has been the money that we have kept into the liquid base? So this is how you can see the whole portfolio parameters are parameterized and tracked so that the better portfolio management is actually done at the ground level. Now, while you want to get this information on your dashboard, there has to be some data that needs to be fit. So therefore, you need to know certain aspects from your portfolio. And what does that mean? That means your stock holdings. These are your stocks. So if I say these are your stocks, we are looking at APL Apollo, we're looking at Ashok Buildcon, so on and so forth. So what we are looking at? We are looking at what is the weightage, say if I have invested 10 lakhs into a portfolio, how much? So this stock is having 4% of allocation. This is having 2.9% of the allocation. It is having 1.95% of the allocation. So here, if you see that the concentration risk will be actually zero. Stock concentration risk is no, because this is currently at less than 5%. So no stock is having more than 5% of the allocation. So then comes the portfolio beta. We have calculated that 6.9% is the portfolio beta, that is calculated based on per script volatility measure. Then we know that, okay, for every stock we have taken certain target price, and we have to see what is the target risk reward ratio, what is the current values that have come with it, then whether that risk reward ratio is favorable, average, best, or we need to watch out. So that based on the financial model, based on the metrics that we have put into the system will tell us which need to be acted upon, which are best, which are average, which have to be washed out and to be acted. So therefore, rather than looking and digging into each and every stock, for that matter, we can directly look into the stock that needs to be actioned upon. So then obviously we have in the stock, so whether we need to exit out of it or not, that depends on the stop loss. So these are the different parameters on which we say that, okay, we need to exit or not. So now this is a proprietary financial model we have developed. So based on this, we'll just see whether we want to go for a, you can say, trailing one, or we want to go at the highest price entry. So that is how we can look at it. And if there are any auto actions, it will sell. So based on the parameters that are happening, we know that this has been triggered, this has been triggered, this is the watch out, and target has not been hit. So based on the parameters, it has told that, okay, we need to come out of it. So here in this case, it is saying that this is to be there. While this is the batch, we know that the stock has gone down, we need to exit out of. So based on our logic, it has told that to come out of the stock, sell. Now again, for all these things, there are the exceptional action. That means an oversight by the fund manager or a broker or an agent or all those analysts needs to be there, who would look into it and then decide whether we want to hold it, or we want to sell it, or we want to monitor it. So you want to monitor it, you want to hold it, or you want to sell it. So therefore, so it does not mean it is not about robotics. You can just put in the numbers and the robot will tell you buy, sell, buy, sell, buy, sell. You will keep on churning the portfolio without any official result coming out of it. So having said that, putting at the end of this analytics is the prudent, or you can say the knowledge acumen and the information based upon the market inputs that a fund manager has to decide whether he wants to hold, monitor, or sell the stock. So this is how. Now when you do this, that is when your portfolio parameters are filled in. So if this is right, then this is right. So at the portfolio management level, we look into these parameters for that. So now this brings us to the next key element about what are the strategies then we can look forward to the portfolio booking. So now here is a simple thing. If we are looking at, say for example, portfolio, and we are saying what are the measures I can take. First and foremost, we have to go at the stock level entry. It is not the sector story, it is not the economy story. Currently when the volatility is higher, it is all about the momentum. It is all about the stocks. Like in Hindi we say that the Bahti Ganga mein haath dhona hai. So if there is a flowing river and you want to wash the hands, go wash the hands. Then you do, okay, the broader fundamentals of the company should be good. It should be a profit making company. It should have the low debt. It should have a very good risk reward ratio for that matter, and very good price to earning ratio. And if all those factors fall into the line, the next best thing you need to do is to get into the stock, and once you have made money, just exit out of the stock. So exiting timely within this volatility is a good thing. You cannot expect to hold a stock for a period of, say, next say for example, what we say that for the period of the next 6 months or 8 months, you could see the stock going up by 30% and then falling by 30%. You would have missed not only the time but also the money on that swings that happen. Just because the volatility is there in the market, you will see stocks going up and down multiple times over the month. So therefore, the story is getting into the best stocks, holding on to it. Once it goes up, book the profit, moving the profit that back to the gold profit component to be put into the gold. The capital can be rotated into the next trending stock for that matter, because every stock has a cycle of bullish, tapering up, and then bearish. So when you have bought it at the upswing, you have made certain returns, you have exited out of it, putting the profit back into the gold. And if the market is going down, go into the next stock which is actually at its upward spiral. that will enable you to have a better cumulative returns on your portfolio and you to be into a command of your portfolio for that matter. So now this brings back onto us in current scenario. I'm not recommending any of the stocks out of this. I'm just citing this as an example as a layman. If you want to say optimist, okay, Rajat, I need to see what opportunities are there. Are there any really good buys, or is there any list I can then dig in, or I can see as a reference, because there are say 5,000 stocks and there are two exchanges. I'm not sure which one to jump into. So just let me give you an insight. Not only this is a recommendation, but will actually enable you to have an insight on it. So that is the stock opportunity. So here, if you will see that what we have done, we have taken here a filter where the stocks have fallen by around 5% and above over the last 1 to 3 months. Now, if you see this, now let me see. We are talking about 1 week. So we have JSW Energy, which has fallen by 16% in a week. We have Coforge fallen by 15%. We have software like Sonata Software. We have Chennai Petro fallen by 17% over the last 1 week. And if we see 3 months period, it is 35% down, 35% down. Now, if you say that, okay, these might not be that good a companies, that is the reason why it has fallen. No, it is 35% down. Now, if you see that in a 1 year, it is still up by 21%. And if 5-year period you will take from 2019 till date, that means accounting for COVID also for that matter, it is already up by 200 to 300%. So even if you see the logically out of it, even after accounting for this, so that means it is actually 313% plus 35%. I'm just putting as a rough number on it. If we are not concerned about the you can say it is absolute terms. In the absolute terms, I'm just knocking off it from the higher figures and adding it back onto the higher figures. So therefore, GSW Energy in the 5 years has gone up by around 700%. Now it has gone up by 700%. In 6 months, it is up by 38%. So that means if 6 months it is up by 38%, and in 1 week it has fallen by say 16%. So technically it was 38 plus 16, 54%. So it was technically at 54%. So now, therefore, if as a layman you need to a starting point whether I should go into this stock or not, and you want to research on the stock, whether stock is profitable or not, fundamentally strong or not, technical charts or not, whether I should put money or not. So you have this list, some of the good scripts that have fallen down over the last 3 months, and then you do your own research and then decide whether you are going to buy these scripts cheap or not. Because tomorrow, once the market stabilizes and the election euphoria or the uncertainty is over, these, even if they don't shoot by over 100%, they even recover back their 35-40% of the returns. You are home. So you are technically home. So now this brings us to the main aspect for this. So here we have made a very detailed, and I've kept it very fast paced so as to not for you to lose interest, but also cover the all various aspects that goes into the portfolio management, checking how to analyze the main markets, how you can dig into the data, how can that data enable you to have a better portfolio strategy, view, analytics, and then based on that, how can you. So therefore, to wrap up the things, in terms of the portfolio actionables, keep on going onto the stock specific theory, not sector specific theory. Some stocks are really doing good and are at the buying cheap. They have been corrected a lot. Go for very good buys. You can go to Polycab, had been a tremendous example based on that IT raid that had happened. Kotak had been a good buy. We have seen Vodafone Idea to a certain extent had been there, but since the whole market has been negative, it has put a downward pressure on all this for the winter. But the point is, you need to able to have those you can say distress buy for that matter into the equity, and this will enable you to make an entry into the stocks if you have not made it. But yes, at the same time itself, if tomorrow the results of election results doesn't come good, we can see a free fall into the market. But having said that, what does this mean? How can you distress or your portfolio from the potential negative return? So that means you need to have a very stable portfolio. You need to have a very stable portfolio, having the fixed bond portfolio, a fixed income portfolio. You should have the guaranteed returns assets in your class. So it is not only the equities based on which you will be trying to reduce the risk by getting FMCG or pharma stocks into it, because equity at the end of the day investors get into the recency bias. Whatever you have been seeing recently, you think that the same will go. Now, if you see in last 1 week or a 1 month, the stock has losing 35% of the returns. And in the next 6 months, if the market doesn't move, you are not going to recover that money. So therefore, what does the correct is the better asset allocation that you should have. The money should be as per in sync with your risk appetite, time horizon, your financial goals, whether you understand that product itself or not. If every day you wake up in the morning and check your mobile app for the returns on the portfolio, then you are already into a mistaken place for that matter. Thank you so much. This is Rajat signing off. Have a great day.